I know you talked about this a lot last week at the Bitcoin conference, but I do want to ask you again about your Bitcoin $1 million call, especially as we see Bitcoin wavering again, dipping below 40,000. When are things going to get to $1 million?
You know, it's somewhere between 2026 and 2030 is where we think that $1 million from $40,000. I don't think people believed me when I said it, but I meant it. And many people think, okay, so you're assuming that institutional investors become huge holders of Bitcoin. No, we're not. We're assuming, though, that they will move in gradually, and by the time we hit $1 million plus, they will have a 2.5% exposure to Bitcoin. Now, this is such a big idea, and that is such a small allocation.
Yeah.
I think they will regret not having more. This is the first global, private, meaning not overseen by any government, digital, rules-based monetary system. It is a big idea, and my mentor, Art Laffer, when he was collaborating with us on our first white paper in 2015 on Bitcoin, he said, this is what I've been looking for, a rules-based monetary policy. It might not be the right rule, but it's a step in the right direction. It's a great store of value because it's mathematically metered to stop at 21 million units, so that's a quantity rule. So great store of value. But not a great means of exchange, right? That would mean a flat price rule. But we think over time, even that will, thanks to the Lightning Network, become more of a means of exchange and a unit of account, playing all three roles of money. When Art and I, and Chris Berniski at the time, our analyst, were collaborating, I remember saying, Art, how big could this be? This is amazing. And he said, well, how big is the U.S. monetary base? And back then it was $4.5 trillion, and Bitcoin was $6 billion in market cap. Today it's $800 billion. He said, well, $4.5 trillion. Today, that number is $9 trillion. So, you know, it's a very big idea. Bitcoin mining as part of utility ecosystems is going to accelerate the shift towards renewables. And the genomic revolution is going to help us grow food in areas maybe away from Ukraine, as it's in quite a bit of turmoil, in other areas that are not as friendly environmentally to food production. So innovation solves problems. That's all we do. We've got a lot of problems, and inflation is another problem. We don't think it's going to be long lasting, but if it is, and if one of the reasons is a labor shortage, automation, artificial intelligence, robotics solves problems. What we believe the market does not understand is we have entered the sweet spot of exponential growth trajectories. Most of the market thinks in linear terms. Most of our careers, we've experienced primarily linear growth, growth that slows down, decays to the nominal GDP growth rate over time. We have a few experiences with exponential growth. Amazon is a very big one. When we were buying Amazon in 2003, what we were saying to investors is, if you believed Amazon could grow anywhere in the 20 to 30% range for the next 20 years, would you buy it? You put that into a dividend discount model, you would buy that all day long. But that's not how people were thinking about it. If we're right on the amount of disruptive innovation that is going to disturb the traditional world order, the broad-based benchmarks are not going to be the place to be. Now, they'll always be tried and true. There are some stocks that are going to be able to weather all of the disruptive innovation that we see because they have great management teams. But so many companies in the broad-based benchmarks have gotten used to giving investors a little adrenaline with manufactured earnings, share buybacks, or increasing dividends. And they've leveraged up to do that, and they have not invested enough in innovation. For the kind of innovation to participate in it, in the innovation we see ahead, companies have to sacrifice short-term profitability and invest aggressively, because we are in a lot of winner-take-most opportunities because of artificial intelligence. So if we're right, then in between now and 2030, the market cap associated with truly disruptive innovation is going to move from $10 trillion today, which is less than 10% of the market, to 210 trillion. This is just in 8 years. So that's a 30 to 35% compound annual rate of return. We don't own any Twitter. And we've started moving out of most of the social platforms because there's a lot of competition out there, number one. I think Meta platforms, so Facebook, the sharp deceleration in its revenue growth to somewhere we think or their guidance was 3 to 11% for the first quarter. That was shocking and really brought to light TikTok is taking a lot of oxygen out of the room. And Twitter also, I would say the management change was another reason for us. Whenever we see big management changes, typically we're going to expect, this new executive, even though he was the CTO, kind of putting his own mark on the platform, and so that causes some uncertainty, and I feel like Jack's leadership was very important to evolving Twitter to where it was.
Is there anything that would get you back into that stock or into social media more broadly?
Well, one of the reasons we did hold Twitter is we thought, because of its verification roots, that it would be a good platform for NFT verification, and they've talked about it to some extent. If we saw Twitter insinuating itself into that world aggressively, we might become more interested, but I am interested in seeing how they do evolve the platform. Should it be a subscription service as opposed to advertising, taking away, advertiser fears that they're going to be put next to some content they don't want to be associated with. Subscription, that would be a huge transition. Might be interesting though. When it comes down to Tesla, the stock, the company and the stock, we pay a lot of attention to its barriers to entry. And as long as we see those moving up, and they are moving up, whether you're talking about battery technology, it's going to take a long time to catch Tesla. And what I mean by that is the traditional automakers. It's the only company with an AI that has designed its own AI chip for autonomous driving, taking a leaf from Apple's book. And in terms of artificial intelligence, critical to success is high quality data, and it has more data, orders of magnitude more data than all of the auto and technology companies combined going after this space.
But do you think it's also sort of more of a zero-sum game in EVs, that Tesla's just going to be so dominant for so long that the others are not going to be able to catch up?
Well, I do think from a cost point of view, its vertical integration has given it a tremendous advantage relative to other companies who are used to outsourcing everything. And so in terms of the winner take most, that's not as much about EVs, it's about autonomous, because that is a winner take most opportunity. And so the company with the best AI expertise and the largest bodies of high quality data and the domain expertise associated with battery technology, because autonomous will be electric, the electric transportation future. I think those companies are going to win, and there aren't going to be many of them. Our confidence is highest in Tesla.